Hello, everyone, and happy 2026. It's been an eventful year, 2025, so it's going to be a great review here that we do. As usual, I'm Bob Thompson and founder of Thompson Investment Partners, and we've got Martin Danielak on the call with us this quarter again. And I'd just like to highlight the fact that Martin is financial advisor and associate portfolio manager now, so you'll see him as an integral part of the team going forward.
I
Welcome,
appreciate
Martin.
that, Bob. And yeah, what a year it's been. It started out with a tariff tantrum in the beginning of the year, a lot of fear in the markets during that period of time, but then it ended up one of the best years in recent memory for global assets. There's a lot to unpack in this update as we'll briefly talk about 2025. We'll talk about what's happening globally, what most investors are likely missing, and how to position for the years ahead. 1 year ago, I remember being at this dinner presentation, and it was titled American Exceptionalism. All that anyone could talk about was AI. And, there were some pockets of strength there, but it wasn't the true leaders of the year. What were they?
Just as we get into the assets here, I just want to review a little bit and say that, what's most important for our clients is we deal with clients that, have made their money, want to retire, know where they are, where they want to be, and how they get there. And although the purpose of these quarterly calls is kind of talking about markets, it's one of the factors that's important. It's not necessarily the most important. What's most important is, hey, is your portfolio doing for you what you need it to do for you going forward? And that's why we tend to make everything unique for clients. So we're talking broad strokes here about markets, but I just want to highlight the fact that everybody's unique, everybody's portfolio is unique, and we manage them that way going forward. So anyway, yeah, Martin, the best asset class here was gold in 2025, and we've been talking about that for a couple of years. Kind of ramped up the amount in people's portfolios as of a couple of years ago, because we thought it was a when question, not an if question. And if you kind of take your position there and wait for the market to come to you, it's going to happen sooner or later. And a lot of people missed this move last year because it was unexpected. Things happen when they're the least expected, generally speaking. So gold was the big winner this year, and by default that helps the Canadian markets, right? The Canadian markets are fairly heavily weighted to gold, maybe 12-14%, and you'll notice a lot of money managers last year probably underperformed because they just weren't there, right? And now everybody's kind of racing to get into that area, and we can talk about that more going forward here. But I think what you said about everybody kind of chasing the last 5 years returns that really showed up in 2025, and I think that's just the start of some of the things that we're going to start to see different.
Yeah, you spoke about that in terms of, in 2024, we were talking a lot about gold. At the beginning of last year, we were talking a lot about miners because gold had moved and the miners hadn't. And that was a great opportunity for this past year. Our investment thesis was generally over the past few years is focused around precious metals, commodities, and value investments over the S&P. Why this occurred is because we knew that there was a lot of debt levels. We wanted to hedge against potential inflation. 2022 was a great example of that. And then we've seen a lot of, news events around deglobalization. The world is definitely changing fast, especially the last few days, and few weeks. How has our overall investment thesis changed, if at all?
Right. I think a lot of the day-to-day noise that we hear doesn't necessarily matter. It might matter that day, but it doesn't matter in the long run. And I think we're entrenched in the mid to long run as to what's going to happen. And that is, you talked about exceptionalism earlier. U.S. debt right now is kind of as a percentage of the GDP of the country is kind of worse than Greece was in 2011, and the whole world panicked in 2011. We had this European debt crisis because of the amount of debt. Well, we're greater than that now in the U.S., or at least the same as a proportion of their economy. So why isn't everybody panicking? Or maybe they're starting to. Because they always said America has the reserve currency, America can print money. It's not a big deal if the debt is in the US. But I think people are starting to realize that it is a big deal and it is going to be a problem. And with some of the global events that are happening, people are selling off the US dollar, right? We heard, I think it was Denmark or Norway the other day, said they're going to sell $25 billion worth of US treasuries, all of the US treasuries that they have. Now, a lot of people aren't going to announce it, but they're going to start to do that. And you know, that's where the world sees, oh, wow, maybe the US dollar is being challenged a little bit as far as the reserve currency is concerned. Money flows into other areas from that perspective.
Yeah, and that brings us to, an interesting post that you and I both shared with our team that Ray Dalio, which is one of the most famous hedge fund investors historically, posted about his book called The Changing World Order. And that book was focused on how certain countries go broke through, unsustainable debt, internal and external conflicts, and then, perhaps a new technology that comes around like AI that really shakes up the employment situation. He said it's happening now. The existing fiat and financial system are all starting to break down, and conflicts, we're seeing them pick up domestically and around the world. So that brings us to an important slide, and this is something that we have shared with clients before. So I'll pull it up right here. 1 second. And this slide right here is gold versus the US stock market over the last 30 years. And this is a relative chart. We love to use these relative charts, and that just means that it's plotting one asset versus the other, so you can see if money's coming into one or out of one. And in this instance, you can see it's gold versus the US stock market. So when the line is going higher, that means gold is outperforming. So money is going into gold, and when it's going down, it means vice versa. And we've pointed this out over the last few years, and lately you've seen a major change. You've seen one favoring gold that typically leads real assets and commodities. What is gold telling us today, Bob?
Well, first, before I answer that question, I'll just say, why is gold important? Right? Gold is important because it is the smartest asset in the room, as I say. And why is that? People say, oh, it's a pet rock, right? It's a shiny metal. I wear it around my neck. Why is it so important? Well, because it's always been a part of the monetary system. And recently, we've seen that, central banks hold US dollars. That's what they've been holding for many, many, many years. And just in 2025, we've seen that gold has started to outpace the US dollar as far as central bank reserve assets. And that's extremely important. People are going back to the old days when you held a hard asset that nobody could default on, that you owned in a vault somewhere, that belonged to you and it wasn't somebody else's liability. So that's why gold's so important. It's rare. It's hard to get out of the ground. You can increase the supply a lot, and that's why it maintains its value, and that's why central banks are starting to buy into that again. And I think that was important just to review that, because you and I talk about gold a lot, and everybody thinks, oh my God, all they do is ever talk about gold. Well, not necessarily the case. Gold is a very smart asset. It depends on interest rates, inflation, currencies, supply, demand, global macro events. All of that is factored into the price of gold. So that's why we talk about it. So, I think gold's telling us right now that people are starting to, question the global financial system and fiat money. Throughout history, paper money always kind of goes to zero, ultimately. Right. So, and it all comes back to hard assets at some particular point in time. Now, this is a, 100-year cycle that happens, right? It just, as Ray Dalio talks about, we're kind of at a pinch point right now of a 10 to 20-year transition point in global economic powers. And, the last time this happened was the end of World War II, right? So it's been a long, long time, way more than anybody's lifetime that is alive today. So this is a pretty important event. We're starting to see a transition in global economic power, military power, etc. And in that kind of decade that happens, there's a lot of volatility, and people go towards assets that aren't anybody else's liability, that they can hold, that maintain their value. And why we were positive on it is because not a lot of people owned it, right? And it's still the case. Not many people at all own gold, precious metals, and that goes for platinum, palladium, copper, right? All commodities are really underowned, and that's why I think there's going to be a big catch-up trade here over the next few years. So that's what gold's telling us, that people are a little bit unsure of the financial system and where things are going.
You mentioned real assets quite a bit, so I do want to shift, to the next slide, which highlights over the last 100 years. Real assets versus financial assets. So real assets are commodities and real estate, basically. Collectibles are also real assets. Anything with scarcity that isn't stocks or bonds, and stocks or bonds are financial assets. And you can see that we're at a historical low, and these historical lows typically happen around turning points. And we believe that we're at a turning point, or within one right now, where the past environment won't look like the future, and potentially we believe that real assets will outperform moving forward, as gold is usually a great predictor of it. Where gold starts outperforming stocks, usually real assets follow. Can you comment on some of the environments that we've seen in the past here?
Sure. If you can remember one kind of quote from this discussion, it's the obvious is obviously wrong, right? And what do I mean by that? Whatever's obviously going to happen in the future is already baked in and already factored into the market, so it's not going to happen that way, right? The only thing that happens is what people aren't expecting to happen, because that's not factored into the market. So that's why we had the big rally last year in Canada, which nobody expected. Everybody thought Canada was a bit of a basket case as far as their economy, our politics, etc. But Canada outperformed, and people still don't believe it. So that's a good thing. So when everybody believes that commodities are going to do well and financial assets aren't going to do well, believe me, Martin and I will be talking about financial assets, buying financial assets, not commodities. Now we're a long way away from that, but we're going to focus on kind of where we are right now at the beginning of this cycle. So yes, that chart is amazing. When you look at that chart, real assets versus financial assets, it tells you that people just aren't invested in this space, right? And people have forgotten about it, right? Returns have actually been pretty good over the last couple of years, but still it hasn't even made a dent in the in kind of this capital rotation. People haven't really in earnest started to sell off all the winners over the last few years. They're still chasing those. They haven't started to sell off the winners and move to other areas. So we're still, that tells us we're still pretty early on in the cycle. It just makes common sense to me. I don't know why it isn't common sense to most investors, but when something is down that much, your downside risk to buying into a sector like that is fairly small, right? You're not buying at a peak, right? You're buying at a trough. And I think that's a when question, not an if question. So in other words, you take your position and you sit and you wait for the market to come to you, and the gains can be pretty good when that's the case. And I think we're in that environment right now. You see that chart is as of 2020. We're a few years down the road, and it's just been a little bump so far as the upside. And this tends to happen every 20 years. You tend to have these sort of opportunities.
Exactly. And over the past number of decades, we saw falling interest rates, globalization, and debt balances, so financial leverage by governments just printing money, which supported the stock market in most of these environments. Now you're not having that same effect. Like in Canada, interest rates were lowered close to 3% over the last year, but if you look at mortgage rates, they're at the exact same level, because the government lowering rates won't impact the mortgage rate that much because of how much debt we have on our balance sheets. They're going to remain elevated. So that is a shift of environment. What I want to bring up here is the best asset classes by decade, and it goes back to the 1930s. And what we want to highlight are similar environments where real assets outperform, which are the 1970s. And you can see that gold was one of the best asset classes. And again in the 2000s, which where gold was the best asset class.
Right.
In both environments, inflation was probably the most important thing that you want to look at. We always want to hedge for inflation. So can you comment on this and why we might be in a different environment today?
Yeah, I don't know if you've ever seen those charts, but it's fascinating. There's charts that say, what happened in 1971, and you see, the world was just going along fine, and then 1971 everything changed, right? From employment, from social, economic, the hippie movement, all of this sort of stuff started in the early 70s, and it was all due to kind of an environment that we're in right now, a rapid change in the world, right? And that's when the world went off the gold standard, and Nixon said, we're not going to give people gold anymore for currency. The US dollar is just going to support itself. It's not backed by gold. And that changed a lot of the politics. It changed a lot of the ways that people looked at economies. It changed inflation. It changed interest rates. So the 70s were a very, very transitional time, and I think we're in that time again. And you look in the 70s here, at stocks, bonds, cash, et cetera, and inflation, and you see, one of the big ones was inflation, right, sitting at 7.5%. I mean, that was big at the time, and they had to combat that inflation by raising interest rates dramatically. And gold was the biggest winner in the 70s, but what isn't on this chart is other commodities. Oil also went up by 20 times. Copper went up, zinc, everything, commodity related went up. And the US dollar was hurt during that time, right? So I think, what's important here is, gold's kind of the first out of the gate. And as we talked about before, that's the one that tells you that there's some things going on that are different. But then it follows through with the rest of the commodities, and that's, I think, what we're going to see going forward. Then we look at the 2000s, right? And you see, again, the gold was a big winner in the 2000s, coming off of kind of the tech bubble, et cetera. And, I've said ad nauseum in our chats here that I think we're in an environment similar to the early 2000s going forward here. And you know why I still believe it? Because nobody else believes it. I say this to people and their eyes glaze over and they go, oh, but AI and tech stocks and Microsoft and they're all doing great. And I say, okay, fine. I'm happy then. Nobody believes in the thesis. That's why it's probably going to work out extremely well. So you see that, again, in the 2000s, gold was good, but copper had this time, or I think it was over a 6-month period, copper doubled or tripled and then set a new base. In the 2005, 2006, around that time. And we're starting to see that with commodities, right? Silver, just hit $100 today, right? A few years ago, it was 25, right? Just 2 or 3 years ago. I mean, that's big. It could happen with copper and oil. Not saying it's going to, but in these sort of environments, you started to get a reset in the commodities. And, the 2000s were definitely like that. And that was 25 years ago now. So remember, I mentioned this happens every kind of 20 years, right? The 1970s, 2000 was about 25 years after 1975, right? So, that's why we're pretty positive. And I think what's really important, again, Martin and I, right, we pay a lot of attention to kind of historical norms. And if we can find something that is way outside of a historical norm, then, we feel pretty comfortable with that. And I'll just say that the last, commodity cycle in 2011, individual investors owned about 12% of their portfolios in commodities. That was at the top. Right now, individual investors own about 3% of their portfolios in commodities. Another reason why we think we have lots of room to run here, and there's lots of room for capital rotation. In other words, money to flow from one sector to another. And it could be pretty dramatic, right? I mean, you look at some of these big tech stocks are worth $4 trillion. 25 years ago, there wasn't any stocks that were worth $1 trillion. Now there's a bunch of stocks worth $1 trillion. What if one of those stocks is worth $4 trillion? What if $200 billion came out of it? I mean, that's 5% of it. It's nothing. $200 billion went to the commodity sector. It would be incredible. The sector can't take that. It isn't big enough to take that. So that's why we you can see some extraordinary gains in these sort of markets.
And that brings us to our last chart that we want to share, which is called Canadian Exceptionalism. Yeah. This is the last relative, strength chart that we show, and we're plotting the Canadian market versus the U.S. market, the S&P 500. And you've seen a major trend change occur here in the last 2 years, and we've been talking about it. Last year, we called that we believed that Canada would outperform the U.S., and it happened. So that's great. But it's not about what just happened. It's about what we think will happen moving forward. And the last time this occurred was in the early 2000s, as we highlighted that real assets outperformed during that period of time. We think we can be in an environment just like the 2000s because this can last for up to a decade. And you stated those commodity exposures are relatively low, and as investors globally look to increase it, Canada should benefit already from metals, but also to energy, and then other related sectors. It can be a really increasing part of not only our market, but our economy. So that's a key thesis of ours moving forward.
Canada and Australia are the two global markets that mining shares trade in, right? So even if it isn't a Canadian company, mining shares are trading here in Canada. So the Canadian market tends to do well when commodities do well. That's just the nature of the business. A lot of people, we've talked about this before, but I think it's important to highlight here again that markets tend to revert to the mean. In other words, if something is way out of whack from the norms, it's going to come back to the norms and probably overshoot, right? And I like to say that in weather, right? I mean, in Vancouver here, if we have, a month or two of no rain, we're going to pay for that, right? At some point, we're going to get a month or two of rain to come back to our norms. So whether it's the weather, whether it's the stock market, whatever the case is. So I'll just say, I've mentioned this before, but 2007, the Toronto Stock Exchange and the Dow Jones Exchange were the same level. They were at 14,000. Today, the Dow Jones is 50,000. And the Toronto Stock Exchange is about 30,000. So there's a huge divergence. And I wouldn't be surprised, no guarantees, we don't know for sure, but I wouldn't be surprised at the end of this cycle if the TSX is the same or even greater than the Dow. So there's a lot of room possibly to make up during this cycle. So another reason why we're fairly positive is the fact that we're so far out of whack. And that's what this chart shows, is the Canadian market versus the U.S. market. And, these trend lines are important. Once we cross that line, as we see there, it could pull back. It could go down below that again. But that's when we start to get interested and look and say, okay, has the trend changed here? And if it has changed, it has a long way to go to get back to what it was 15, 20 years ago.
That's a great point. And, after the recent discussion in the last 10 minutes, a lot of people were probably thinking, well, we should just pile into resources at this time. But that might not necessarily be the case, is it, Bob?
I think that, nothing goes up in a straight line. Everything's 2 steps forward, 1 step back. So a lot of people have been piling into this space right now, which means, the higher it goes up, the bigger the pullback's going to be, right? So everything in this world is measured, right? You say, what are your goals? What are your objectives? What are we trying to accomplish? And, let's get there in a measured way. I think, if anybody's interested, Ray Dalio, again, one of the best money managers in the world, did a report recently where he talked about how they manage money in non-correlated assets. And I think that's what's really important. If you can have 2 assets that do 10% over time, totally different ways, manage them in the portfolio, put them both in the portfolio where one zigs, the other zags, you're going to have a lower volatility portfolio and you're still going to do well over time. And that's exactly how we manage money. So everything in the portfolio is put in the portfolio for a reason. It's not just a bunch of our best ideas thrown together. Everything is there for a reason because we're thinking about market events going forward. What happens if we get a big recession? There's things that'll perform well. There's things that won't, and hopefully get us through that. So we're always got insurance in the portfolio. Commodities in this sort of a market environment are and gold is some sort of insurance, right, in a portfolio. So you never go 100% in any direction, but you certainly overweight things and strategically allocate so that you can get to your objectives, and that's what we're trying to accomplish. A lot of our clients have already made their money, and they say, "I just want to preserve it, right? I want to make sure that it's going to be there down the road," and that's how we're managing the portfolios. And commodities are a part of that most people aren't looking at.
Yeah, you've often called it the all-weather portfolio.
Right.
We want a bunch of uncorrelated strategies that all do different things at different times that hopefully provide a smoother experience for all of our clients. So to finish up, we just want to remind investors of a few important tax-saving initiatives. Given we are at the start of the year, there are two opportunities specifically. The first one are flow-through investments. We've spoken to a lot of clients about it before, but these are diversified investment funds in Canadian resource exploration companies that give investors a whole 100% tax reduction or greater of their 2026 investment. So on their 2026 income, they can deduct whatever they invested typically. So we're happy to talk with our tax consultants and your specific situation and figure out, if and how much of this might be appropriate for you. The second item is just RSP contributions. We always reach out proactively to all of our clients, but just for everyone else, remember the RSP deadline for the 2025 tax year is March 2nd of this year. So please reach out to us if you want to learn more or have any questions on these. And finally, we just want to introduce the newest team member of our team, Cameron Slade. He has 7 years of experience here at Raymond James, and he'll be taking on our client service role. So I'll just shift the camera to him.
Thanks, Martin. Looking forward to meeting everyone and working with you in the coming weeks and months. And really glad to be part of the team and excited for what's ahead.
Welcome to the team, Cam. Excited to have you on board.
Thanks, Bob.
Thanks a lot, Cam. And that about wraps it up. We thank all of you for joining us once again. We look forward to a great 2026, and we'll be sending out quarterly reports soon. If you have any questions about anything, please don't hesitate to reach out. Thanks, Bob.
Thanks again, Martin. Look forward to the next one.